Are you investing in the S&P 500 right now? For me personally, 50% of my investment portfolio is in that S&P 500 when I start looking at what I hold in my taxable brokerage account and what I have in IRA funds as well as my 401k. Now, when it comes to the S&P 500, how do you want to invest in it and what are you looking for? There's some very smart things to do to build up that hefty nest egg. And I want to break down the S&P 500 because a lot of people think because Warren Buffett sold it, he knows something that we don't. And even when we've seen the Liberation Day, since we've seen the drawback or the pull down of the market, recession, whatever people are saying, news is news. When we start looking at the last in the peak performance of the S&P 500, it is done incredibly well over an extended amount of time, regardless of Republican or Democrat, regardless of ups or downs, even looking at the housing market, the tech bubble, COVID-19, everything else we've seen, the market has always come back. And when we start thinking of investing in the market, if you're unfamiliar with the S&P 500, it is the group of the 500 of America's biggest companies. I believe it's 504. They make up roughly 80% of the entire US market. When we start thinking bigger picture of tariffs, when we start thinking bigger picture of, global trade, a majority of these companies are at such a scale, they are global companies. When we start thinking of some of the biggest names in here, Apple, Microsoft, Nvidia, Amazon, Meta, Berkshire Hathaway, Google, all of them are massive worldwide global companies. So when we start thinking about tariffs, when we start thinking about other things in place, they are still and make up a majority of the portfolios when it comes, if you're doing market weighted cap of the S&P 500. Now the index is market weighted by market capitalization, meaning the bigger companies there are, they are going to be eating up a lot more of this, which is where in those top 10 companies, you see a lot more of the tech side, those Amazon, those Meta companies. Now, when we start thinking about the index itself, there's, I believe, 491 companies, but a couple of companies have more than one or a different kind of share. Now, knowing the index, how has it performed? Over its entirety, it has performed better than mutual funds and even actively managed funds that financial professionals charge for because of the incredibly low fees, which we'll talk about in just a minute. Since we look at the S&P 500 and only the S&P 500, they have outperformed a whopping 91% of managed large cap funds over the last 15 years. Think about that. So if you're paying a fee for someone to manage a portfolio or manage a mutual fund, over 91% of managed large cap mutual funds, the S&P 500 itself has outperformed over the last 15 years. So when we start kind of breaking this down, last 3 years, the average annual gain was 10.69. Thinking of those high yield savings accounts around 4%, CDs maybe 4.25, 4.5. When you start looking at the index average over the last 3 years, you're at 10.69%. When we start kind of scaling back and pulling out a little bit, the past 5 years is at 14.64. This in part because of the boom that we've seen really in 2023, 2024. When it came to tech stocks, they were absolutely on fire, which is interesting because 2022 was a really big pullback from the market as well. Then we even pan out further looking at the last 10 years. So thinking of the last decade within that S&P 500, we are sitting at 10.27%. You are still north of 10% over the last 10 years. Thinking of your average return over that last decade, 10% would have been your return. If you're going in here and you're making regular contributions and you have the growth aspect that's in there with the compounding, it is going to make and really have a difference in your portfolio. So how do you invest in the S&P 500? There are really two different ways to invest in it. Number one would be buying all of the stocks independently to hold and carry all 500 different stocks, which is the absolute worst way. Now, there's some people that will take different sectors or take different buckets and build a portfolio in itself. But if you're trying to really build the S&P 500 portfolio, really buying, selling frequently, adjusting for fluctuating weights on top of the companies that are within the index makes it incredibly hard, makes it almost impossible to track the S&P 500 without something like our exchange traded funds. So the best way to do this is really those ETFs, low fee S&P 500 index funds, not the mutual fund variety that a lot of people have fees or associated around. It is the simplest, it is the easiest. When we start looking at the VOO, which is the Vanguard S&P 500 ETF, or even looking at the ultra low expense ratios and thinking of the Spider S&P 500 Trust or the SPY, there are some very solid options to consider. And I believe iShares has one as well that is very similar, the IVV, which again is ultra low fees, ultra low expense ratio. We're talking about a 0.03, 0.02%, which means you're paying $2 to $3 for every $10,000 you have invested every year, which is very, very cheap. Now, when we start thinking about investing, dollar cost averaging, there are really two ways to put money in there, is either putting your money in all at once, which honestly, I really don't advise, or doing the dollar cost averaging. So if you do lump sum investing, and again, I really don't advise doing this. So let's say you got a $50,000 lump sum, you got it on a settlement, you got it from insurance, whatever it may be, taking that 50,000, dropping it into the S&P 500 where it sits today. Now, the American economy usually will recover and has always covered after a big pullback, but you might be buying it at a peak, meaning when it does come down a little bit, you might see your nest egg or the money you put in there decrease a little bit faster than you want. This is where I feel like people have a very strong emotional tie to it, and they'll go ahead, they'll cash out, they'll take their losses, they'll lose that money, and they will never invest again. This is the reason why when it comes to dollar cost averaging, so again, you can think, so if I have $50,000, if I want to take the next 2 years to get in the market, 3 years to get in the market, what am I going to invest every single week, maybe 2 weeks, maybe once a month? What kind of lump sum investing or what kind of dollar cost averaging are we going to invest into the S&P 500 to go ahead and build that portfolio? So my portfolio has been growing for a multitude of years. With my dollar cost averaging, I choose Monday morning. If you do your research, if you Google, if you hop on, Bing, whatever it may be, you will notice that when the market is digesting the news over the weekend, majority of times to buy in a lot of places, even looking at AI, Copilot, ChatGPT, say Monday is the absolute best day to buy into the stock market. So what I started doing is dollar cost averaging every Monday morning. I put $250 in there. That means I'm putting $1,000 a month into that S&P 500 every single month, $1,000 every single week, $250. This doesn't make a difference regardless of what's going on. When we start looking at the market is up, the market is down, there's tariffs, there's this, there's that, regardless of the news, regardless of social media, regardless of anything that is going on in the market, even if Warren Buffett, who I truly admire, is completely selling out of the S&P 500, he has said, and I still stick by it, that everybody should own the S&P 500 as a baseline, as really basic. If you're a very simplified investor, holding on to the S&P 500 for an extended amount of time would make a big difference. Now, remember, when it comes to investing, we are looking at a minimum 5+ year time frame. So I don't want to see people investing money for a wedding, money for a down payment for a house. I only want to see, and honestly, the way that I steer people, 5+ years, if not a longer runway for the money that you're putting into an investment portfolio. I don't want you to invest a large sum of money. The market pulled down 10 or 20%. All of a sudden you're down 20%. That need comes up, or that want that you need, and you go ahead, you pull all the money out to do a down payment on a house, you pull it out for a car, whatever it may be. I don't want to see you take that sort of loss when it comes to an investment strategy. All right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think, and also how you invest in the S&P 500, and let me know in the comments what you think, and thank you guys for watching.